While the S&P 500 struggled this year, 3 ETFs quietly delivered over 90% returns. And if you think you missed the boat on gold because it's already at record highs, you're dead wrong. September 2025 might be the most explosive month yet for gold investments, and I'm about to show you exactly how to position yourself before the biggest catalyst hits in just 13 days. Gold just smashed through $3,500 per ounce, a level most analysts thought was impossible just 6 months ago. But here's what Wall Street doesn't want you to know. The real money isn't being made in gold itself. It's being made by the companies that dig it out of the ground. While gold has gained an impressive 35% year-to-date, 3 specific ETFs have delivered returns that would make any hedge fund manager jealous. We're talking about gains of over 90% in less than 9 months. And the most shocking part, this rally is just getting started. Right now, we're witnessing a perfect storm of conditions that's creating the most favorable environment for gold investments in over a decade. The Federal Reserve is set to cut interest rates on September 16th and 17th, with the CME FedWatch tool showing a 90% probability of at least a 25 basis point cut. When rates fall, non-yielding assets like gold become incredibly attractive compared to cash and bonds. But that's not all. The US dollar has weakened by 2.2% over the past month alone, making gold cheaper for international investors and driving massive demand from overseas buyers. Add persistent geopolitical tensions, trade tariff uncertainties, and questions about Federal Reserve independence, and you have the recipe for a gold supercycle that could last years, not months. But here's the kicker that most investors completely miss. When gold moves up $100, mining stocks don't just move up $100. They can move up $1,000 or more. This is called operational leverage, and it's the secret weapon that sophisticated investors use to amplify their gold exposure. The numbers prove it. Gold is up 35% this year, but the mining ETFs I'm about to show you are up over 90%. That's the power of leverage working in your favor. Let me introduce you to the first ETF that's been absolutely crushing the market. The VanEck Junior Gold Miners ETF, ticker GDXJ, has delivered a staggering 93.99% return year-to-date. This isn't a typo. We're talking about nearly doubling your money in less than 9 months. GDXJ focuses on small capitalization companies in gold and silver mining, which means they have the highest leverage to gold price movements. When gold goes up, these smaller companies can see their profits explode because their cost structures are more sensitive to commodity price changes. The fund holds 88 individual securities with top holdings including Alamos Gold, Pan American Silver, and B2 Gold Corporation. These aren't the household names you might recognize, but they're the companies positioned to benefit the most from rising gold prices. The fund has $6.87 billion in assets under management and charges a 0.51% expense ratio, which is reasonable for the specialized exposure you're getting. GDXJ also pays a 1.35% dividend yield, so you're getting paid while you wait for gold prices to continue their ascent. But here's what makes GDXJ particularly attractive right now. Junior mining companies are in the early stages of what could be a multi-year expansion cycle. Many of these companies have been conservative with their operations during the lower gold price environment of recent years. Now, with gold at record highs, they're ramping up production, expanding existing mines, and developing new projects. This operational leverage means that every additional dollar in gold price translates to multiple dollars in increased company valuations. The second ETF that deserves your attention is the VanEck Gold Miners ETF, ticker GDX. With a 91.14% year-to-date return, it's almost matching the performance of junior miners while offering significantly more stability. GDX focuses on established, large capitalization gold mining companies with proven track records and diversified operations. We're talking about industry giants like Newmont Corporation, Agnico Eagle Mines, and Barrick Gold Corporation. GDX holds 66 securities with $19.52 billion in assets under management, making it one of the largest gold mining ETFs in the world. The top 10 holdings represent 65.84% of total assets, giving you concentrated exposure to the best-managed companies in the industry. These companies have geographic diversification across Canada, the United States, Australia, Brazil, and South Africa, which reduces single-country political and operational risks that can plague smaller miners. What makes GDX particularly attractive is the quality of its holdings. These are companies with established mining operations, experienced management teams, and the financial resources to weather commodity price volatility. Newmont Corporation, the fund's largest holding at 13.47%, is the world's largest gold mining company with operations on 5 continents. Agnico Eagle Mines, representing 11.80% of the fund, has a track record of profitable operations spanning over 60 years. These aren't speculative plays. They're proven operators that know how to extract maximum value from rising gold prices. The fund also provides dividend income, currently yielding 0.90% annually. While that might not sound like much, it's income you're receiving on top of the spectacular capital appreciation. And here's something important that happened recently. GDX underwent significant changes to its benchmark index and investment strategy after September 19, 2025, positioning the fund to better capture opportunities in the current gold environment. Now, for investors who want pure gold exposure without the operational risks of mining companies, there's the SPDR Gold Shares ETF, ticker GLD. With a 26.96% year-to-date return, it might seem modest compared to the mining ETFs, but this represents the baseline performance of physical gold itself. GLD is the largest gold ETF in the world, with over $107 billion in assets under management. What makes GLD unique is its simplicity and direct connection to gold prices. The fund holds physical gold bullion stored in secure vaults managed by HSBC Bank and JP Morgan Chase Bank. This isn't paper gold or gold derivatives. These are actual 99.99% pure gold bars that you indirectly own through your ETF shares. Every share of GLD represents a fractional ownership of real physical gold. The fund tracks the LBMA gold price PM and has an expense ratio of just 0.40%. Unlike the mining ETFs, GLD doesn't pay dividends because physical gold doesn't generate income, but it also doesn't have the operational risks that come with mining companies. There are no equipment failures, no labor strikes, no permitting delays, and no political instability affecting specific mining regions. When you own GLD, you own gold, pure and simple. However, there's one important tax consideration with GLD. The IRS treats it as a collectible, which means long-term capital gains are taxed at a maximum rate of 28% instead of the typical 20% rate for most securities. This is something to factor into your overall investment strategy, but it shouldn't deter you from the fundamental opportunity. So why is September 2025 such a special moment for gold ETFs? We're seeing a convergence of factors that creates what I call a perfect storm scenario for precious metals. The Federal Reserve meeting on September 16th and 17th represents a pivotal shift from the current 5.25% to 5.50% interest rate range that has persisted throughout 2025. Lower interest rates make gold incredibly attractive because it reduces the opportunity cost of holding non-yielding assets. But there's more. Gold has broken through multiple technical resistance levels with massive volume, creating momentum that typically attracts trend-following investors and algorithmic trading systems. We're also entering seasonally strong periods for gold consumption, particularly in Asia, where festival seasons drive physical demand. Central banks around the world continue their gold accumulation strategies, providing structural demand support that goes beyond traditional investment flows. The technical setup couldn't be more bullish. Analysts have consistently revised their 2025 gold price forecasts upward throughout the year, from $2,756 per ounce in January to $3,200 in July. Now, with gold already exceeding those targets, some analysts are projecting $3,600 to $3,900 by the fourth quarter of 2025. With $4,000 possible by mid-2026. If these targets are achieved, the mining ETFs could see additional gains of 50% to 100% from current levels. Now, let's talk about how to strategically allocate between these three ETFs based on your risk tolerance and investment objectives. For conservative investors who want gold exposure with minimal volatility, I recommend a 70% allocation to GLD and 30% to GDX. This gives you the stability of physical gold with some leveraged upside from established mining companies. You'll sleep well at night while still participating in the gold rally. For balanced investors seeking optimal risk-adjusted returns, consider a 40% allocation to GLD, 40% to GDX, and 20% to GDXJ. This approach gives you the best of all worlds: physical gold stability, established miner exposure, and some high leverage upside from junior miners. This is probably the sweet spot for most investors. For aggressive investors who want maximum leverage to gold price movements, you might consider 30% GLD, 35% GDX, and 35% GDXJ. This allocation maximizes your exposure to mining company operational leverage while maintaining some physical gold as a foundation. Just be prepared for higher volatility with this approach. Regardless of your allocation strategy, I strongly recommend dollar-cost averaging your entries rather than trying to time the perfect moment. Gold and mining stocks can be volatile in the short term, even during strong uptrends. By spreading your purchases over several weeks or months, you reduce the risk of buying at a temporary peak. But let's be completely honest about the risks involved. These aren't boring index funds that track the S&P 500. Gold ETFs, especially mining ETFs, can experience dramatic swings that would make most investors uncomfortable. GDXJ in particular can move 5% to 10% in a single day during volatile market conditions. Mining companies face operational risks that physical gold doesn't have. Equipment can break down, permits can be denied, environmental regulations can change, and labor costs can spike unexpectedly. There's also currency exposure to consider. Many of the mining companies in GDX and GDXJ operate internationally, which means their revenues and costs are affected by currency fluctuations. A strengthening dollar could hurt their profitability even if gold prices remain stable. And in major market crashes, everything tends to go down together, at least initially. Gold's safe haven properties typically reassert themselves after the initial panic, but you need to be prepared for potential short-term volatility. Geographic concentration is another risk factor. While these ETFs are globally diversified, they still have significant exposure to specific regions that could face political or economic instability. Mining operations are also subject to nationalization risks in certain countries, though the major companies in GDX have learned to manage these risks through diversification and political risk insurance. Here's the bottom line: the Federal Reserve meets in just 13 days, and that meeting could be the catalyst that drives gold ETFs to even higher levels. You have 3 distinct ways to play this opportunity, depending on your risk tolerance. Conservative with GLD and some GDX exposure, balanced with equal allocations across all 3 ETFs, or aggressive with maximum mining company leverage through GDX and GDXJ. Don't try to chase performance by jumping into the best-performing ETF of the moment. Instead, build a strategic allocation that aligns with your risk tolerance and investment timeline. The gold rally has more room to run, but it won't move in a straight line. Volatility is part of the game, and your allocation strategy should account for that reality. The convergence of Federal Reserve policy changes, technical breakouts, seasonal demand factors, and geopolitical uncertainty has created one of the most compelling investment opportunities in the precious metals space in over a decade. The question isn't whether gold will continue higher. The question is how you want to position yourself to benefit from what could be a multi-year supercycle in precious metals. If this analysis helped you understand the gold opportunity differently and showed you concrete ways to participate in this trend, make sure to like this video and subscribe for more market insights that actually matter. The next few months could be extraordinary for gold investors who position themselves correctly before the crowd catches on. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.